So, Matt, what is your word of the day? How do you see today shaping up?
So the word of the day is inflection, and here's why. So it's already a big week, and there's a lot going on here. We started the week off with the DeepSeek headlines, and couple that with key earnings reports on mega caps, Meta, Microsoft, Tesla today, and Apple tomorrow. And there's a Fed decision out today, PCE report out Friday, and we're only a week off an inauguration. So it tees up for an important and busy day and week for that matter. But it's inflection because it might shape up to be a potential turning point or inflection. Looks like we could shift some focus from mega caps into some undervalued sectors. I talk about that a lot. So maybe a little recalibration in the markets and investment strategies in general.
All right, so you think it might be a recalibration. We were hitting on this earlier with a guest, the fact that value, if you look at these two Russell ETFs that we're about to show, values outperformed growth since the hawkish cut back in December. How do you view the value trade right now? Are you looking for stocks that pay dividends? Are you looking for income, or are you looking for growth?
Yeah, so a little bit of both. It's an interesting conversation to have. So one of the more common conversations we've had with clients right now is what to do with the concentrated mega cap positions they've got. And we've kept the stance to hold the positions, and you have to start looking elsewhere to diversify into some undervalued stocks. It's standard practice in managing an investment portfolio, and I'm afraid it's actually got lost on some investors. So, from that, while tech struggled Monday, dividend-focused ETFs like SCHD, which is Schwab's U.S. dividend equity ETF, it was up more than 1% that day. So, traditional value and defensive sectors had nice gains on Monday, and it's just a reminder there's more to the market than just tech and AI. And if Monday made investors uncomfortable, we've got some different areas we're looking at.
Matt, we want to get to your pick for today. What is your pick and why?
Prologis. So it's not necessarily a household name, but really it should be. They're a $100 billion REIT. They're the largest owner and manager of industrial properties and warehouses and distribution centers in the U.S. And, again, this is a pure dividend growth play, so we're not typically recommending REITs, but they've got a very healthy yield, 3.4% yield, and you just mentioned it. I mean, the shares are up 15% so far this year, but it's still off 30% from its 2022 peak, and they had an earnings report out last Tuesday that was very favorable, and the stock jumped. But there's just plenty to like here, and it's adding a great dividend growth name at an attractive valuation, and it's completely understated at this point.